In the name of Allah, the most beneficent, the most merciful. We're excited to welcome all of you to Azad Trusts. We broadcast legal and social awareness through Park Law Guide and support souls. Before we dive into our exciting new topic today, I want to remind you to subscribe to our channel. And don't forget to click that bell icon. So, without further ado, let's jump right into today's exciting topic. History and introduction of income tax laws in Pakistan. Introduction. Taxation system plays a vital role in the economic growth and development of any country. According to Black's Law Dictionary, a charge by the government on the income of an individual, corporation, or trust, as well as the value of an estate or gift. In Pakistan, tax can only be levied through the Act of Parliament. Taxes are share of state in income, production, and consumption, and never liked by individuals or corporate bodies. However, they have very important role in economic development and income redistribution. As per recorded history, oldest records on taxes suggest that tax was levied during the reign of Egyptian pharaohs on oil consumption. Tax collectors called scribes used to visit houses to ensure that citizens were using only taxed oil and leftovers of other substitutes on which tax was not payable were not in use. Ancient Greeks used to collect taxes during wartime called aisphora. However, once emergency was over, collection was suspended and earlier taxes refunded through spoils of war. In the Roman Empire, earliest taxes were customs duties on imports and exports called portoria. Caesar Augustus was considered the most successful tax strategist of the Roman Empire. Sales tax was imposed at 4% for slaves and 1% for general public. Pakistan inherited taxation system of British India. At the time of independence, Central Board of Revenue constituted under the CBR Act 1922 was responsible to collect federal taxes. Main sources of tax collection were income tax, sales tax, central excise duty and customs duty. In Pakistan at federal level, the general classification of taxation comprises of direct taxes and indirect taxes. Introduction, Tax collection in Pak. Income Tax Rules 2000 into the FBR under the authority of Section 237 of the Income Tax Ordinance 2001 made the Income Tax Rules 2002. These rules were published on 1 July 2002 in Extraordinary Gazette of Pakistan at pages 1819 to 1966. IT Income Tax Rules 2002 were promulgated by the Federal Board of Revenue, FBR, on 1 July 2002 in exercise its powers granted under Section 237 of the Ordinance. Direct Taxation. Federal income taxes are administered by the Federal Board of Revenue. The period from 1 July to 30 June is considered as a normal tax year for Pakistan tax law purposes. The FBR collects tax through mainly inland revenue, which deals with all kind of tax collection from the citizen of Pakistan on income generation in Pakistan. Whereas, customs deals with the tax collection of all kind of import and exports involving foreign exchange income and revenue. Indirect taxation. Indirect tax, or more commonly known as sales tax, is also applicable on supply of goods and provision of services. Under the 18th Amendment to the Constitution of Pakistan, the right to charge sales tax on services has been given to the provincial governments, whereas the right to charge sales tax on goods has been given to the federal government. Corporate income tax rates. In addition to corporate tax, there are other applicable income taxes including super tax, minimum tax, and tax on undistributed reserves. Generally, manufacturing business is taxable at corporate tax rate, whereas trading business and commercial imports business is taxable as minimum tax. For example, 5.5% withholding income tax is applicable on commercial imports and is payable at the import stage. This 5.5% withholding tax will be considered as minimum tax, and corporate tax is also applicable, Whichever is higher will be the tax liability on this business. Now Pakistani taxpayers, individuals or businesses can use online income tax returns filing websites like TXApp to submit their returns easily and securely. Applicable laws in Pakistan. Acts. Customs Act, 1969. The Sales Tax Act, 1990. The Federal Excise Act, 2005. The Tax Laws Amendment Act, 2023. The Tax Laws Amendment Act, 2020. Finance Acts. Benami Transactions Prohibition Act, 2017. Anti-Money Laundering Second Amendment Act, 2020. Anti-Terrorism Third Amendment Act, 2020. Public Finance Management Act, 2019. The Pakistan Single Window Act, 2021. Right of Access to Information Act, 2017. The Federal Board of Revenue Act, 2007, amended up to 30th June 2012. Voluntary Declaration of Domestic Assets Act, 2018. Foreign Assets Declaration and Repatriation Act, 2018. Income Tax Amendment Act, 2016. Income Tax Second Amendment Act, 2016. Income Tax Third Amendment Act, 2016. Ordinances. Income Tax Ordinance, 2001. The Islamabad Capital Territory Tax on Services Ordinance, 2001. Tax Laws Second Amendment Ordinance, 2022. Income Tax Amendment Ordinance, 2022. Tax Laws Third Amendment Ordinance, 2021. Tax Laws Second Amendment Ordinance, 2021. Tax Laws Amendment Ordinance, 2021. The Tax Laws Amendment Ordinance Number 1 of 2020. Tax Laws Second Amendment Ordinance, 2019. Tax Laws Amendment Ordinance, 2019. Income Tax Amendment Ordinance, 2021. Assets Declaration Ordinance, 2019. Assets Declaration Amendment Ordinance, 2019. Voluntary Declaration of Domestic Assets Ordinance, 2018. Foreign Assets Declaration and Repatriation Ordinance, 2018. Income Tax Amendment Ordinance, 2018. Income Tax Ordinance, 1979. Old Laws. Rules. Income Tax Rules, 2002. Customs Rules, 2001, updated up to 30th June 2020. Sales Tax Rules, 2006. Federal Excise Rules, 2005. Benami Transactions Prohibition Rules, 2019. FBR AML CFT Regulations. AML CFT Sanction Rules, 2020. Countermeasures for High-Risk Jurisdiction Rules, 2020. Sharing of Declaration of Assets of Civil Servants Rules, 2023. Pakistan Single Window Trade Data Dissemination, Exchange and Utilization Rules. Pakistan Single Window Evidence of Identity, EOI, Regulations. Asset Declaration, Procedure and Conditions, Rules, 2019. Sales Tax Special Procedures Rules, 2007. Sales Tax Special Procedure, Withholding, Rules, 2007. Recruitment Rules. The Inland Revenue Reward Rules, 2021. Inland Revenue Uniform Rules, 2021. Customs Reward Rules, 2012. SRO Notifications Orders Circulars. In addition to Tax Acts, Ordinance and Rules, the tax collection system of Pakistan is very complex, and therefore to run day-to-day business and address issues and ambiguities, different SRO, notification, Orders and circulars are also issued. Brief history of income tax laws in Pakistan. Before partition. Income Tax Act 1860. In the undivided India, income tax was for the first time in the history introduced in 1860 by the British government through Income Tax Act 1860. James Wilson, first Finance Member of India, to overcome the financial difficulties after 1857 War of Independence. In this act, exactly the same pattern was followed as that was prevailing in those days in the United Kingdom. The Act was enforced effective from 1st July 1860 and was continued for a period of 5 years up to 1st August 1865. Then it was withdrawn in 1865. One of the main features is that agricultural income from land, above the rental value of Rs. 690 per annum was taxable. Tax was levied on persons earning income from Rs. 200 to Rs. 500 at 2% and from Rs. 500 and above at 4%. Exemption was available to persons earns income below Rs. 200 including agriculture income. To all government properties. Exemption was also granted to cultivation of land whose rental value is below Rs. 600 per annum. Religious and charitable institutions rates changed from time to time. Although income tax of 1860 was not successfully operated, but the procedure concerning levy and collection of taxes was continued under different nomenclature. License Tax Act 1867. Income tax was not applicable for next 2 years thereafter. License tax was introduced with the License Tax Act of 1867, which was abandoned the next year. Income earned up to 200 rupees per annum was not taxable under this law. Amounts earned above this limit were taxable at the rate of 2%. In this act, agricultural income was exempted from license tax under License Tax Act 1867 and Act No. 6 of 1880. Certificate Act 1868. Later on in 1868, the License Tax Act name was changed to the Certificate Act 1868 and the exemption limit was raised to 500 rupees, but the rate of tax was also reduced to 1.6%. The act was abandoned the next year. General Income Tax Act 2. In 1869, Certificate Act was converted into General Income Tax Act 2 and agricultural income was again brought under taxation. But this time different rates of tax were proposed on different types of income. The act was enforced for only 1 year time and in next 4 years, tax was levied by annual legislation. In 1972 exemption limit was raised to 1000 rupees. In 1877 further developments came in the form of License Act 1877 wherein tax on trade and access on land was proposed. The Act of 6 of 1880 and other local acts continued till 1886 to the whole of India. Income Tax Act 1886. Income Act 1886 was an important landmark in the history of taxation of the subcontinent. This was the first systematic tax legislation in the subcontinent which brought remarkable improvements to the tax system. A proper definition of agricultural income for the first time was made in the Act and complete exemption and concession in payment of tax was granted to a person paid life insurance premium. Income Tax Act 1886 itself continued up to 1918 and during its life of 32 years, only one major amendment was made in it in the year 1903. There were only 4 heads of income. Income from salaries and pensions. Profit of companies. Interest on securities. Income from other sources including property income. Tax was levied on individual different sources of income separately not on aggregate basis, total income. Flat rate of 5 pi in the rupee of 192 pi, 2.6%, was applied on income above Rs. 2000 rate of 4 pi, approx. 2.083% on salary income between Rs. 502,000 rupees was applied. Basic exemption was Rs. 500. Later on, enhanced rates of taxation by gradation and graduation were introduced in 1916. 8 different tax rates were introduced for different income brackets. The increase in tax rates was caused due to the First World War 1914. Additional income tax was also introduced in 1917 for the first time in the form of super tax. Till 1916 there was no penalty for late filing of return except companies, but in 1917 it was made obligatory for all taxpayers whose income exceeds Rs. 2000. Act 0 F 1886 stood in force for 32 years till 1918 with a number of amendments made from time to time which are imperative part of the Act. Graduated super tax on income over Rs. 50,000 on undistributed profit of corporation and other entities was introduced through Super Tax Act 1917 which was subsequently modified into Super Tax Act 1920. Income Tax Act No. 7 of 1918. Act No. 7 of 1918 was introduced to recast the entire tax laws of 1886. New concepts of total income accrues, arises, or received has been introduced in the law for the first time in British India to determine the rate. The levy was imposed in respect of taxable income in the year of assessment based on income of previous year. There were 6 heads of income under the Income Tax Act 1918. Salary income, interest on securities, income from house property, business income, income from professional earning, other sources. Still there was no capital gain tax. Rates of taxes was from 4 pi to 12 pi in a rupee of 192 pi. Income Tax Act of 1922. The Act continued in force till 1922 which was replaced with the Income Act No. 11 of 1922 on recommendation of All India Income Tax Committee appointed in 1921. The Income Tax Act 1918 and Super Tax Act 1920 was consolidated into Income Tax Act 1922. In the Income Tax Act 1922, administration of income tax was shifted from the hands of provincial governments to the central government of India. Another remarkable feature of this act was that the rates were to be enunciated by annual finance acts instead of basic enactments. This Act, like Act of 1918, was applicable to all incomes except capital gain, casual income and income in kind not convertible into money except rent-free accommodation. Tax was levied in the year of assessment on the basis of earning of previous year. In Income Act 1920 to set off loss against profit or gain under one head of income against the other one was permitted provided that the loss was relating to the same assessment year. This Act was amended as many as 20 times between 1922 and 1939. Income Tax Act No. 7 of 1939. The increasing need to finance the growing annual expenditure and fiscal deficit resulted from Second World War. The British government had to take steps to generate more tax revenues to overcome the financial crisis. In 1935, an expert committee, a year, was formulated to investigate the existing income tax system from all possible angles and to submit a report on tax incident and efficiency of tax administration. For the first time, residential status was defined in the law, receipt basis was converted into accrual basis. Carried forward of business loss was permitted for 6 years. Slab rates were introduced, splitting income into slabs, and progressive higher tax rates was charged on successive slabs of income. In 1944, Pay-as-you-earn scheme was introduced. This scheme, which still continues in a little different shape, requires an early depositing of tax by certain persons. In 1945, distinction between earned and unearned income was made and some concession was provided on the earned income. After partition. Promulgation of Income Tax Act, 1922. After independence, both the governments of India and Pakistan, in 1947, adopted the Income Tax Act, 1922 as its official income tax laws. The provisions of the Act were extended to the whole of Pakistan except the special areas. Formation of the Taxation Inquiry Committee. In June 1958, a special taxation inquiry committee was formed to review the existing income tax system and submit recommendation to the CBR for amendments in current tax laws. The committee consists of officials and representatives of trade and commerce. The recommendations of the committee were accepted and Income Tax Act 1922 was amended accordingly. Abolition of super tax. In 1959, super tax was abolished on income of all persons except registered firms and companies. The rates of each slab were expressed as a percentage of income. Change of fiscal year. In 1960, financial year was changed to commence on 1st July and end on 30th June. Previously, it used to start on 1st April and end on 31st March. In